we just figured it, right? We took that number and figured it. 26,150. Okay. Then we're going to go back and look and see, okay. How much we put in. Is this talking about the same company? That didn't make sense to me.
He's talking the same company.
So he actually had 110,000 and he thought he was going to, he's pretty close, wasn't he? Because it was 26.
Yeah, it was 20.
And when he ended up with 20,000. Okay, they had deposited 20, but we were due 26, whatever. Okay. Oh, there it is. Just wait. Wait on that. Okay. So we got to pay an extra $6,150. So that's we've got to send that in to them, right, on our income tax. Right, on our income tax return. And we record this adjustment that we just discovered in the adjustments section of our worksheet. So in our adjustments column, we will have an income tax adjustment for that $6,100. So we would debit the income tax expense and credit the income tax payable for $6,150, showing that we got to pay this much more and it's due. And then that's going to be filled in after you've done these calculations. Go back to your worksheet and fill in those two places. That's one of your adjustments. But notice you have to do that adjustment after you've completed all your other columns and carried them across and figured your net income, right? Okay. So, you see what I'm talking about? It's kind of a backwards situation. Okay.
Move ahead and then move back.
Move back. You got to go ahead and do it, but just don't complete everything yet. Just leave it and then go back to your adjustments column and make that adjustment. So that's the trick. Okay. Whoa. And what do? We always make our adjustments, You're going to have adjustments to make on different things, just like you did for the partnerships and for the sole proprietorship, supplies and insurance and all that. The same kind of adjustment, only this one would be included in it. Okay. Then closing, we close the revenue again. Still using that handy-dandy income summary, right? Close it to the income summary. What's next? Expenses, same procedure. Look and see if we have a net income or loss in our income summary. And close it to, instead of capital though, it gets closed strictly to retained earnings. So you don't have to worry about separating it up for partners, or it just goes straight into retained earnings. So it's not that bad, right? And we close it out. Close it out to retained earnings. Any other kind of items that we have to deal with, highly unusual, and those are things like we talked about a little bit in the partnership one. If you have a loss on sale of an item or anything extraordinary loss, you had a tornado and it tore up everything that would go under your extraordinary losses at the bottom after you've done your corporate income statement, after you've shown regular operations, right? Then if you have anything extraordinary, either you had a windfall, you sold something and made a lot of money on it, or a piece of land or a piece of equipment, or anything that happens or a loss occurs, that would go at the bottom. It's like we did have one for other income and revenue. Now you'll have one, I believe we'll even call it extraordinary losses and gains. Just another section at the bottom of that. Make sense? It's just something different. You just figure it somewhere else. Okay, let's see if we can get through this. This is on paying the dividends, which we will have some entries on paying the dividends, declaring the dividend, payment of cash dividends. And sometimes they pay dividends, they issue people shares of stock as their dividend. And sometimes, have you ever heard of this? They split the stock. The person, instead of having 10 shares at $100, they now have 20 shares at $50. Very, very good when that happens, right? Because then it starts building back up, usually to the $100 level in the regular market. And recording any appropriations of our retained earnings, which would be like for stockish, preferred dividend payment, etc. Your retained earnings note is not a cash fund. We're keeping it in our business. We're saying this is the money that we've made that's in the business. It's not a cash fund. It is then allocated or reinvested usually in the same business as more inventory, right? Buying plant and equipment. We allocate we have so many retained earnings for that, various types of other assets, and it may be distributed to our stockholders, which we hope after we set up our budget for next year and say, we're going to need this, this, and this. This is how every business operates. This is how this school operates. We set up our budget first. What are we going to need? Then, after we find out and allocate that, I'm going to say we're going to have to keep this amount in retained earnings to do these things we've got to do next year. Or it may be distributed in the form of dividends to your stockholders. And these appear down in the stockholders' equity section of your balance sheet. So it's going to show, retained earnings is going to show anything that those retained earnings are being allocated for or held for. When you do have a dividend, the declaration date is the date when your board of directors has agreed upon it. The date of record is the date that you're going to actually give it. So they declare it on a certain date, and in that declaration, they set up the date that they're going to actually pay it. Okay. And then the actual payment date is the day on which you just go ahead and show your entry of paying it. All right. When we declare we're going to do a dividend. Down there in our retained earnings section, we're going to take it out of retained earnings, and we're going to put it in a common or preferred account called dividends payable. Oh, okay. It's not a warning or something. So on the declaration date, that's what we did. On the record date, we just, over here, we're going to make a list of who all's going to get it. It has nothing to do with an entry. It's a place where we're keeping up over here with who gets stock in our big book of stockholders. And we're going to show who's getting it, who's getting the dividend, and how much they own, and how much their dividend's going to be. On the payment date, we're going to do it just like we do any payable account. We're going to debit the payable and credit cash. And the money goes out to the people. Just like if it was a salary payable, only it's a dividend. Okay. Stock dividend is when they issue more stock. Maybe made on a pro rata, how much you own. You get if you own 10% of the company's stock, you'll get 10% of the new the amount we're allocating in stock. It involves an account called Common Stock Dividend Distributable. It's an equity account, and it's used to record shares that are going to be issued as a result of a stock dividend declaration. In other words, we're sending them out in stock. If we give it to them and we're giving them a value that's over the par value, stock they're getting is over par value, we've got a paid-in capital in excess of par that we're going to use, just like before. So we declare it. When we declare it, same thing for all declarations. It comes out of retained earnings and it goes into whatever we declared to pay, which in this case would be common stock dividends distributable. Okay. So whatever we take out of retained earnings, and whatever reason we're taking it out, we put it in that special account to show what those retained earnings are allocated for. This is just going to take us doing it, I know, and you're going to do that for the value, the par value, and then if we distributed stock that was worth more, then the rest of it goes in the paid-in capital in excess of par. Okay. And then on distribution, we debit the distributable one and credit common stock. In other words, it goes from what we were going to distribute into the common stock, showing that those were distributed in our common stock account. All right. I know you're not going to remember all this, but you're gonna need to just look it up as you go, basically. But I just want you to have a general understanding. The book value again is whatever stock it is, the total equity divided by the number of shares gives you the book value of each share. You just divide the number of shares that have been issued into what you're showing as your equity amount for those shares, and you can get how much they're worth. Okay. If you have a stock dividend, the book value stays the same just in a stock distribution simply because you've just got more stock and more value distributed. That's not going to make a difference on that. Book value per share, you take your amount of equity for that share and the number of shares, and you just divide it. If you have a stock split, that means we're going to stocks. Difficult to sell. Apple stock right now is at $600 a share. One time it was $5. How many shares do you think they can sell right now at $600? Who's going to buy those shares? Not me. So they're wanting to get more activity going on in the market. They'll do a split. And that lowers the cost per share, right, and people can afford it. Let's say Walmart got up to, I know, and this has happened a bunch of times with Walmart stock. It gets up to about $60-something a share, and they'll do a split, bring it down to like $30 or $25, and then people, if they want activity, then people can afford it. Okay, and get more activity in the marketplace. All right, so they would do doesn't change anything in the capital accounts. It just requires a memorandum and says, on this date, we declared a 3-for-1 stock split, reduced the stated value of the common stock from $75 to $25 a share. They've really cut it on down there, haven't they? And what they do then is showing instead of the 40,000 outstanding, now they have 120,000 shares outstanding. But it has to still be part of that amount of shares they have authorized from the beginning. Can't just add more shares. They have to have 120,000 shares as authorized by the board in order to do it. Okay? Appropriation is that's what we're setting it up. What are we going to do with it? We'll restrict some of it to dividend payments if we have preferred stock. If we have preferred stock or stock that we know we have to, we're not just going to say, here's all the retained earnings, go give it to the people, because we've got to have money to reinvest, to fix our equipment, because if they distribute it, it takes all their cash out. What have they got? No cash. How are we going to do business? Right? So we don't distribute it all. We decide how much we can, and we allocate the rest to the things we need. So in this case, they're going to allocate some for retail center construction, and this is how they're allocating. Taking it out of retained earnings and putting it in an account that says retained earnings appropriated for retail center construction. So when they do that, that's when they would debit this account and take it and credit cash to do whatever it is they allocated this money to do. Make sense? It just gets allocated. Then when it's sort of like a payable, and then when it's done, it's taken out of that and paid. Okay. Didn't do any cash, right? We just set aside that amount of the retained earnings. Okay. All right. Other capital transactions, and I'm going to let y'all basically read through this. Donated capital is at fair market value. People donate it. You would take the land and get it appraised, and that's the amount you would put in your donated capital account, meaning it didn't come in there as a result of stock. It's just something that somebody when the owners donated to the company. All right? So not everything goes in there. It has a special place, but it'll be donated at capital. Treasury stock, and let's say our corporation has some extra cash. We've got a bunch of cash. And we offer treasury stock as an incentive plan for our officers. It means we want to create a demand for the stock, so what we're going to